A Chinese memory company that did not exist as a serious fab 5 years ago just cleared Star Market Review and banked enough fresh public capital to build fabs, while posting what the company itself claims is a 613 to 677% jump in first half revenue, all inside a single product cycle. That is the velocity shock. And the race stake is not about size. Samsung is bigger, not close. The stake is whether Samsung's response time is shorter than CXMT's closing speed. That is the only number that settles this. Picture a single DRAM wafer rolling off a CXMT line in Hefei. Mature node, DDR4, headed for a server rack that Samsung once supplied without a domestic competitor in sight. That wafer is what we are tracking across every leg of this race, from the capital that funded it to the shelf it lands on. A fundraise is not a trophy, it is a clock reset. The moment a challenger converts financial velocity into physical output, two investment cycles are running at different speeds toward the same commodity shelf, and one of them just shifted gear. Samsung's clock on capital formation is measured in decades of accumulated position. The company built its memory dominance through one of the most disciplined counter-cyclical strategies in industrial history, spending into downturns and emerging with share each time. At the scale Samsung operates, a single fab addition is a rounding error on an existing empire. That is not a weakness in isolation. It is the logic of a machine already at cruising speed. When you are already optimized, each marginal dollar of Capex buys less relative acceleration than it does for a challenger still in the power band of its growth curve. Think of it as the difference between a driver who already owns the circuit and a driver who just pulled into pit lane with a full tank. The circuit owner's lap time is dialed in. The challenger's next lap time is unknown, but the fuel is real. CXMT's clock on capital formation ran through a different mechanism entirely. The Star Market IPO review clearance is the event, not a prototype announcement, not a guidance slide. A regulatory outcome that opens a domestic public equity pipeline purpose-built for technology companies at a moment when the company's own reported profitability is accelerating. The company's reported Q1 2026 net profit sits near 24.76 billion renminbi. That figure is company reported and not independently verified, so treat it as a claim, not a confirmed benchmark. But the IPO clearance itself is not a claim. It is a documented regulatory event. The capital tap is open. To render that profit figure at rough current exchange rates, you land somewhere in the range of 3 to 4 billion United States dollars in a single quarter. Stack that against the broadly estimated multi-billion-dollar cost of adding a leading-edge DRAM fab, and the number is not a curiosity, it is a down payment. Samsung's clock on capital formation, the pace of a machine already at cruising altitude, each incremental addition absorbed into an existing empire. CXMT's clock, a single regulatory clearance that unlocks a domestic capital pipeline at the precise moment the company's own reported numbers are accelerating fastest. The gap on this first leg is not one distance closing, it is two different kinds of race. Samsung has the track, CXMT just got fuel. The fundraise is the split time that matters most this quarter, not the revenue guidance. And I want to be precise about why I read it that way. Revenue guidance from a company in a hyper-growth phase is a claim. A cleared IPO review is a mechanism. Capital committed to fabs has a physical conversion rate. That conversion rate is what I'm clocking, not the headline percentage. Here is how that conversion works on the second leg. CXMT's output, reports suggest, is concentrated on mature node DRAM, the DDR4, and comparable generations that still constitute the bulk of volume demand across server and personal computing markets. The fresh fund does not instantly purchase a leading-edge process node. It buys more of what CXMT already prints, and it buys it faster. That means more wafers, more units, and more downward pressure on the commodity price band that Samsung's own mature lines also serve. Samsung's approach to commodity DRAM is deliberate and margin-aware. The company is not maximizing volume on the mature segment. It is managing product mix, pushing higher value configurations, and pulling resources toward the nodes where its technology advantage is widest. That is a rational strategy for a leader. It is also a strategy that assumes the commodity shelf will behave predictably, while the upmarket move completes. CXMT's fundraise tests that assumption directly. Mature node DRAM is the highway lane, wide, high volume, specification standardized across the industry. Samsung built the highway. CXMT is adding lanes to the same road. You do not need to be faster than the original builder to change the traffic pattern. You need to be adding asphalt while the original builder is focused on the on-ramp to a newer road. The Capex split is where the compression shows up, not because Samsung slows down on its leading-edge investment, but because CXMT's investment rate on the mature segment, freshly funded, is running faster than Samsung's incremental additions to the same tier. Reports suggest CXMT's capacity additions are accelerating quarter over quarter. The H1 revenue guidance, if the company's own claims hold, would confirm the volume ramp is already translating to output. Samsung's clock on mature node capacity addition. The pace of a leader managing mix upward, not a leader maximizing volume. CXMT's clock. A fundraise that converts to fabs that convert to wafers at a rate that analyst coverage broadly describes as accelerating through 2025 and into 2026. The gap on this leg is narrower than the first. The Capex split is compressing. Now, I need to push back on my own read of the compression story, deliberately and before we go further. The Capex split closing does not mean the technology split is closing at the same rate. Those are two different clocks running on two entirely different tracks. Conflating them is the most common analytical error in covering Chinese semiconductor progress. I am separating them here because the honest picture of this race depends on holding both at once. On the leading edge, Samsung's finest DRAM runs on process generations that require extreme ultraviolet lithography. That equipment comes from one supplier in the world. CXMT does not have it. Reports indicate CXMT's access to extreme ultraviolet tools is restricted under current export control policy. A documented policy context, even if the granular operational details are not publicly confirmed. Analyst estimates, widely cited across industry coverage though not independently benchmarked, place CXMT roughly 3 years behind Samsung on leading-edge DRAM node. 3 years in semiconductor process engineering is not a rounding error. It is a structural gap. Now here is the Mirage case, because I owe you the strongest version of the other side. On a chart, CXMT's revenue growth rate and Capex acceleration look like a line converging with Samsung's. The percentage gains are extraordinary by any industrial standard. A new fund unlocks additional capital. The momentum narrative writes itself, and it is seductive. But percentage growth from a smaller base is not the same as absolute distance closed on a technology frontier. A car gaining 10 car lengths per lap is still losing if the leader is 20 car lengths ahead, and there are only 2 laps remaining on the track. The 3-year node gap does not compress with capital alone. It compresses with process engineering breakthroughs, with materials science advances, with tool access. And tool access is the one variable CXMT cannot answer with a fundraise. Here is the real lead case. The leading edge is not on the same track as the commodity shelf. Samsung's advantage on the nodes that power high bandwidth memory, the memory architecture that the artificial intelligence accelerator market depends on, is protected by a tool CXMT cannot import and cannot yet replicate domestically at production scale. The mature node pressure that CXMT applies does not translate into leading-edge erosion on the timeline that the artificial intelligence memory market is running on. That market is where the next margin cycle lives. It is like watching a driver gain 3 positions in sectors 1 and 2 on a wet track. Then discovering sector 3 is where the engine displacement gap shows up. The positions gained are real. The engine gap is also real. They are not the same story. Hold both. CXMT is closing one gap and not closing another. The gap it is not closing is the one Samsung's next decade is built on. Samsung's clock on the leading edge node, running on extreme ultraviolet lithography, compounding process generations, setting the pace for high bandwidth memory, and the performance tier where margin is widest. CXMT's clock on the leading edge node, approximately 3 years behind by analyst estimate, running on tools 1 generation below the frontier, with no confirmed path to extreme ultraviolet at production scale. The lead does not compress on this leg. The honest read is that it may widen as Samsung advances and CXMT's tool access remains constrained. This is the one split where China's clock is not the faster one, which brings us to where this race lands in 12 months. My call: CXMT wins the commodity DRAM shelf in volume terms within the next 12 months. The fresh fund converts to additional mature node capacity. The H1 revenue guidance, if the company's own claims hold in reported results, confirms the volume ramp is real and the commodity shelf changes shape. More supply, lower prices, Samsung and SK Hynix managing their product mix upward under sustained pricing pressure. Samsung wins the margin story on the same shelf by moving up the stack faster than CXMT can follow. Whether that retreat is a strategic repositioning or a concession is a question I do not think Samsung has publicly answered yet. That answer, when it comes, is the next split time worth watching. The signal to watch in the near term is the H1 revenue print. If CXMT's guidance holds in reported results, the commodity Capex compression story is confirmed, and the pace of restructuring on that shelf accelerates faster than most Western analyst models currently price in. If it misses, the fundraise narrative loses its foundation and the gap on the first leg reopens. That wafer rolling off the Hefei line, the DDR4 unit we tracked from the capital that funded it through the shelf it lands on, in 12 months there will be more of them, substantially more. But the wafer that determines Samsung's next earnings call is not the DDR4 unit CXMT is printing today. It is a high bandwidth memory stack that CXMT cannot yet approach. 2 wafers, 2 clocks, 1 straight, and they are not racing toward the same finish line. The fundraise is not the finish. It is the moment one clock shifted gear on a straight where the other clock has already found its ceiling speed. Here is what I want you to sit with going into the H1 print. If CXMT's revenue number lands at or near guidance, the commodity DRAM market restructures faster than most Western forecasts currently model, and Samsung's retreat upmarket strategy gets stress tested in real time, not in a projected scenario, but in live pricing data. The question for the comments: which clock hits the commodity floor first? And does Samsung have enough runway on the leading edge to make that floor irrelevant to its margin story? Tell me what you are watching. And subscribe and turn on notifications if you want the H1 revenue print, called the moment the number lands, because that number is either the confirmation of everything this race suggests or the moment the compression story stalls.